Welcome back. Well, we're dialing back to the big story of the day. Amendments to the finance bill will be discussed and cleared in Parliament. We thought it's going to be more about life insurance and whether that sector gets a relief or not. Well, move aside life insurance. It's about mutual funds now. That's the big headline. Mr. Kanabar is now with us to make sense of things. Mr. Kanabar, as we were discussing in break, the equity market anyway isn't giving any returns. People aren't making money. And now looks like the government wants to make debt unattractive, at least debt mutual funds, market-linked debentures. So what's left?
So first, let me begin with a general proposition that ordinarily when the finance bill is moved, there are, say, 20, 30, 40, 50 amendments proposed to the Income Tax Act. Representations are made, some of these are considered, and when the finance bill is moved to be converted into an act, some of those representations are accepted and changes made to the finance bill. What we are now seeing is a new tendency, and this has been there for the last few years, where totally new proposals are supposed to be introduced in the Finance Act. Of course, we haven't seen the Finance Act. There is something which is doing rounds, and I'm not too sure whether it is authentic, not authentic, because ordinarily the finance minister will move the amendments and it just gets passed. So we are all seeing what's doing rounds on WhatsApp, and I'm presuming for a moment that that is authentic. But you are right. What we are now seeing is new amendments being proposed at the time of moving the Finance Act. And one of those amendments seems to be that debt market funds will be treated on par with MLDs. So the proposition seems to be that if you have a debt instrument, then the entire income should be taxable. There is no question of long-term capital gains. There is no question of indexation. And should this amendment go through as it is likely to, then we are going to see both MLDs and debt market funds sort of not being the preferred things and therefore not having any tax advantage. And therefore people will evaluate a fixed deposit with a bank, a fixed deposit with a company, a debt market fund, everything on par, and sort of not factor any tax advantage in any of them.
That's fairly put. To the earlier point, I was also wondering this morning, usually, over the years, the finance bill comes with the budget. There's lobbying, representation made. If there are any changes, they're made. The bill is passed, and then one is scurrying to kind of look through in terms of are there any changes. But here, and of course, one just hopes that this is, of course, authentic. It seems like it. We've spoken with industry representatives, etc. as well. Mr. Kanabar, just in terms of post-tax returns, we had somebody in the morning saying that debt schemes will still be a little more attractive as compared to bank FDs. Any thoughts at all there in terms of how to think about that?
I really don't know in what form and shape. So two things. First of all, the new amendment is supposed to come into effect for purchases made after 1st April. So current ones continue to enjoy that benefit. And probably the way we saw in the case of luxury segment of housing, where people rush to buy high-cost homes to shield capital gains, we might see people scurrying to buy debt market funds before 31st March because they will continue to be grandfathered. So that's the one advantage I see. Otherwise, whether you are taxed... Yeah, and there is one other advantage which I must bring out, which is a very interesting advantage. If you make short-term capital gains, then the question is, are you still entitled to deductions under Section 54 and 54F? Because both 54 and 54F, even though there is a limit of 10 crores, if you have held an instrument for more than 3 years, then it is a long-term asset. And although for tax purposes, you may tax them as short-term capital gains, if you reinvested those gains in a house and you fulfill the other conditions, then you would not have a challenge. So that in that sense, it could be an advantage out there if a person doesn't have two houses and is wanting to buy a new house.
Mr. Kanabar, I think what Prashant was also alluding to, we had a gentleman earlier on the show who was perhaps suggesting there was some math that at least they were looking at, that apparently from debt funds, if you withdraw, I think the interest component quarterly or something on those lines, then there is, then you can, to an extent, it's more tax friendly, but I'm not sure if how that math works. But a larger question, So apart from pure equity funds, where mutual funds hold more than 35% in equity, what other category of an investment product enjoys indexation now? I think there are these RBI bonds, the inflation bonds, but the whole concept of indexation, that gets diluted, right then?
Yeah, so I think in some sense what the government is saying is that whether it is LIC, whether it is whatever you are getting, you are making investment decisions on the basis of the returns that you perceive you will get rather than any tax advantage. And therefore, in some sense, the tax advantage which remains is only on equities and nothing else really.
Yeah, we're talking about a rationalization in the capital gains regime in the budget. It didn't happen directly. I don't know if this is some sort of indirect way of doing it, but it's definitely a shock to the system. But just again, purely looking at it from an investor's point of view, listed equity, unlisted equity, bonds, the entire regime, it was always a very confusing regime, short-term, long-term, indexation or no indexation. So where do we really stand?
So today what remains really, and leaving out RBI bonds and things aside really, today all that we are looking at is equity, whether listed or unlisted, and we are looking at everything else being treated or taxed fully, whether as interest income or as short-term capital gains. But really your only tax advantage comes in on the gains, and indexation comes in respect of long-term capital gains, which you make on equities, whether it is listed or unlisted. There will, of course, still be a few other things which will continue to apply, and that's not going to make things very simple. So, for example, there are tax treaties, and while Mauritius and Singapore have been undone, there are few treaties still where you could get advantage, whether it is in terms of interest rate, whether it is in terms of characterization, those will continue. But, and I know that you are looking only at equities and whatever else, but I must also tell you that there are other changes which are supposed to have been brought about, which again, to some extent are shocking. So, for example, we have taxation of royalties and fees for technical services, which suddenly is proposed to be enhanced from 10% to 20% for non-residents. So it's quite interesting the way the government is going about treating things.
Sorry, these are fresh amendments, Mr. Kanabar? The ones that you mentioned?
That's right. So,
sorry, could you repeat that? Could you repeat very briefly the top 2 or 3 other amendments which we may have missed? Go on.
Yeah, I will. So one is that under the Income Tax Act, if a non-resident earns royalties or fees for technical services, then the rate of tax is 10%. That was brought down just a few years ago to realize that yes, India needs a lot of technology. When the technology comes in, the guy who is supplying the technology wants the fees net of taxes. Therefore, if you increase taxes, it actually increases the cost of the person acquiring the technology because he has to remit on a gross basis. Now that 10% is suddenly being pushed up to 20%. So again, people will have to go to take advantage of tax treaties if the rate is lower, because in most treaties, the rate is either 10% or 15%. So again, either you will go to 20 or you'll have to go to tax office, apply for a lower withholding, tax residence certificates, the cumbersome thing. All of those will continue. That's one thing. The other thing is in respect of offshore banking units in ISST. So in the gift city. So there again, the original thing was that 50% of their first 5 years, 100% of the income was tax-free. Next 5 years, 50%. There's now proposed to be made 100% tax-free for 10 years. So a number of changes being brought about really. And of course, as I said, these are all what is there in the public domain. I don't know whether these are actual changes happening or not, but these are the rumored changes.
No, we'll have you, Mr. Kanabar here. We are a little short on time, but these are very important other changes you are telling us. So request you to join us a little later in the day as well to explain these to us, to our viewers. Thank you very much for joining us right now, Mr. Kanabar, and taking us through some of these changes. Appreciate it. Well, commodity markets, what's in focus? Manisha is standing by with that.